Here is the one thing they never put on the exam. The only asset class that actually appreciates during a panic is your own sanity. So keep the strategy tight, your emotions tighter, and remember, if you aren't managing your human capital as well as your portfolio, you're just paying fees to stress yourself out. Let's go.
Doc, I've been staring at this balance sheet, and it looks like an accountant's dream. But if we ignore the extended stuff like human capital, aren't we just flying a plane while looking at an empty cockpit?
James, your analogy is spot on, but it is actually more dangerous than that. An accounting balance sheet is just a static snapshot of past financial activity. It ignores the present value of future earnings, which we call human capital. For an individual, that is often their most significant asset, especially early in their career. By ignoring human capital, one fails to understand the true economic reality. Consequently, they make fundamentally flawed asset allocation decisions that ignore the investor's total wealth.
Right, it's like measuring a marathon runner's health only by the water in their bottle, totally forgetting they still have 20 miles of legs left in them. So how does this human capital actually change the way we build the portfolio?
Think of human capital as an asset with a specific risk profile, James. Research suggests human capital behaves similarly to a mix of 30% equity and 70% bonds. As an individual ages, they trade that human capital for actual earnings, which they then invest into financial capital. Therefore, their economic balance sheet shifts from being human capital heavy to financial capital heavy over time. A sophisticated asset allocation strategy must adjust as this transformation occurs, often by increasing bond allocations to compensate for the diminishing human capital.
That makes perfect sense. You're effectively hedging your own life. But what about the essay-style traps here? If the exam asks me to justify why a target date fund shifts toward bonds, what's the golden ticket?
The golden ticket is to explicitly link the transition to the nature of human capital. You must argue that as human capital, which possesses bond-like characteristics, declines, the financial portfolio must increase its bond allocation to maintain a stable risk profile for the total economic wealth. If they ask you to justify this, always mention that this adjustment seeks to keep the total risk tolerance constant. The trap is ignoring that total wealth includes both financial and extended portfolio assets. You must never view financial capital in isolation.
Got it. Keep the total economic wealth lens on at all times, not just the bank account. Let's shift gears. What about the institutional side, like a university endowment? Do they have human capital too?
They absolutely do, James, though we label it differently. For an institution like a university, the 19 assets include things like the present value of future royalties, or even mineral resources. Conversely, their extended liabilities include the present value of prospective future payouts. A major nuance for endowments is that their assets, like real estate, might be highly correlated with the university's own commercial holdings. This reduces their true diversification, a critical point for any asset allocation analysis.
So if the university owns a bunch of office buildings and the endowment owns similar real estate, they're just doubling down on the same risk. That's a classic diversification illusion, isn't it?
Precisely, James. The diversification benefit is often illusory because both the university and the endowment are exposed to the same economic stress factors. If a local economic downturn occurs, the endowment's real estate income might drop just as the university requires more support. If the exam asks you to describe how university investments affect the endowment's allocation, you must identify this risk overlap. You would justify a change in allocation by highlighting that the current strategy lacks true diversification, increasing the endowment's vulnerability to specific local economic shocks.
We've established that the economic balance sheet is the foundation, Doc. Now, can we break down these asset-only, liability-relative, and goals-based approaches before I get a headache?
Let us demystify these frameworks immediately, James. Asset-only approaches like mean variance optimization or MVO focus exclusively on assets, ignoring liabilities entirely. Liability-relative approaches explicitly model the liabilities, aiming to fund them, often treating the liability as a benchmark. Finally, goals-based approaches segment the portfolio into sub-portfolios, each aligned to specific individual goals, such as lifestyle maintenance or bequests. Each approach defines and manages risk in a significantly different manner.
It's like picking a team. Asset only is for the solo sprinter. Liability relative is for the pension manager, and goals-based is for the family financial planner. What's the secret for the exam when they ask about the risks for each?
The secret is knowing the why behind the risk, James. For asset only, the focus is on the volatility of asset returns, typically measured by standard deviation. For liability relative, the risk is shortfall risk, the probability of failing to have sufficient assets to meet those legal obligations. For goals-based, the risk is the probability of failing to achieve each specific stated goal. On the exam, if asked to distinguish them, you must state that goals-based approaches are not about the law of large numbers. They are about satisfying diverse, individual objectives that cannot be averaged like pension liabilities.
That is a vital distinction. Individuals don't have the law of large numbers on their side like a giant pension fund does. Before we move into the nitty-gritty of asset classes, give me a quick GPS check. Where are we?
We have covered the economic balance sheet, which incorporates both financial and extended assets and liabilities. We have also distinguished between asset-only, liability relative, and goals-based asset allocation frameworks. We are now ready to analyze how we specify asset classes to support these strategies. Remember, the goal is always to maximize the utility of the risk the owner is comfortable bearing, whether that is defined as portfolio volatility, liability shortfall, or failing a specific goal.
Perfect. Let's dive into asset classes. It sounds simple, but I suspect the curriculum loves to make it complicated. Are we talking just stocks and bonds, or is it deeper?
It is much deeper, James. We utilize a framework often associated with Greer that defines three superclasses of assets. First, there are capital assets, which provide an ongoing income stream like dividends or interest. Second, there are consumable or transformable assets like commodities, which are inputs for production. Third, there are store of value assets like currencies or art, which do not generate income but hold value for exchange. This classification is the bedrock for effectively specifying what actually constitutes an asset class.
Okay, so a gold bar is a store of value, and a bond is a capital asset. What about something like a hedge fund or volatility itself?
Those do not fit the framework, James. A hedge fund is an investment strategy that invests in the underlying asset classes. It is not an asset class itself. Volatility is simply a measurable investment characteristic, though some treat it as an asset because it is the underlying for derivatives. For the exam, if they ask you to classify an investment, remember this distinction. If it's a strategy or a characteristic, it doesn't fit the superclass framework. This is a common trap.
Understood. So if a client wants to invest in hedge funds, I need to explain that we're actually buying a mix of assets, not a new superclass. Now, what about the 5 criteria for choosing these asset classes? How do I memorize those for the exam?
Focus on the logic of each criterion, James. First, assets must be homogeneous, meaning they share similar attributes. You shouldn't lump real estate with common stock. Second, they must be mutually exclusive to avoid overlapping risk and confusion in return expectations. Third, they must be diversifying, meaning they don't have extremely high correlations with each other. Fourth, they must represent a preponderance of world wealth, which increases your opportunity set. Finally, they must be liquid enough to absorb a meaningful proportion of the portfolio.
That's a solid checklist. If I'm building a portfolio and I see an asset class with a 0.99 correlation to my existing holdings, I should probably toss it, right?
Exactly, James. A pairwise correlation above 0.95 is generally considered redundant. However, be analytical, evaluating diversification purely through pairwise correlations can be misleading. You must examine how that asset performs in relation to the entire group of assets, particularly during periods of financial market stress. Sometimes an asset that looks like a diversifier in normal times becomes perfectly correlated during a crash. That is when you truly see if your diversification is robust.
That is a brilliant point, Doc. It's like assuming your umbrella will keep you dry, only to find it useless when a hurricane hits. So if correlations are unreliable during a crisis, how do we actually model the portfolio risk correctly?
That brings us to the beauty of factor models, James. Instead of just looking at asset classes, we decompose returns into underlying risk factors. Think of a factor as a fundamental driver like GDP growth, inflation, or interest rate movements. By identifying these factors, we can see exactly what is pushing the portfolio value up or down. You aren't just looking at the label of the stock, you are looking at the engine driving it.
So if I have a portfolio of tech stocks and a bond fund, they might both be riding the interest rate engine. If rates jump, both engines sputter. Is that the secret?
Exactly. If you treat stocks and bonds as separate, you might think you are diversified. But if both are highly sensitive to inflation or interest rates, you have concentrated risk. A factor model helps you see through the label. For the exam, if they ask you to justify using a factor model, you must state that it allows for a more granular understanding of risk. It prevents the trap of believing that different asset labels guarantee different risk exposures.
That feels like looking at the DNA of the portfolio instead of just the outfit. What about these proxy variables? The text mentions using things like tips for real interest rates. How do those help?
Proxies are essential for turning abstract concepts into measurable data, James. To measure real interest rate risk, we use inflation-linked bonds as a proxy. For volatility risk, we look at market-wide index futures. For credit risk, we go long, high-quality corporate bonds and short government treasuries. By using these proxies, you isolate a specific risk factor. You are effectively stripping away all the noise to look at the pure risk component.
It's like using a stethoscope to hear just the heartbeat of the market. Let me see if I've got this. On the exam, if they ask me how to isolate duration risk, I should say what?
You would say that to isolate duration risk, one goes long on long-term treasury bonds while simultaneously shorting short-term treasury bonds. This construct removes the other risk factors, leaving you with pure exposure to interest rate sensitivity, which we call duration. It is a precise surgical strike on risk. This demonstrates to the examiners that you understand the mechanics of factor-based analysis.
Surgical precision. I love it. Doc, give me a quick GPS check. We've moved from the economic balance sheet to asset classes and now into the engine room of factor models. Are we ready to talk about the actual allocation process?
Indeed, we are, James. We have established that the economic balance sheet defines the total wealth. We have classified assets into superclasses to ensure we are diversifying effectively. Finally, we have used factor models to dissect the true risk drivers. Now we must move to the strategic asset allocation process. This is where we determine the target weights that will govern the portfolio over the long term.
Strategic asset allocation sounds like the heavy lifting. If the market is a chaotic sea, is the strategy our compass or our ship?
The strategy is the compass, James. Strategic asset allocation is the long-term target allocation that aligns with the investor's objectives and constraints. It is based on long-term capital market expectations, not short-term market noise. We set these targets to provide the expected risk and return profile. Deviations from these targets, what we call tactical asset allocation, are temporary and intentional attempts to capture short-term mispricing.
So, strategic is the slow, steady march toward the goal, while tactical is the quick pivot when an opportunity pops up. What's the trap here for the level 3 candidate?
The trap is confusing the two. James, candidates often focus too much on tactical moves. On the exam, if you are asked to determine the impact of a change, you must refer back to the strategic asset allocation. You must argue that deviations must be justified by strong conviction, or they risk undermining the long-term strategy. The win is remembering that the strategic allocation is the primary driver of total portfolio returns over time.
Got it. Strategic is the map, tactical is the steering wheel. Now, Doc, the text dives into implementation. Is this just about picking the best fund manager, or is there a systematic way to handle this?
Implementation is the bridge between theory and reality, James. We utilize a structure that includes passive, active, and semi-active management. Passive management aims to replicate an index, keeping costs low. Active management seeks to outperform a benchmark by exploiting perceived market inefficiencies. Semi-active, often called enhanced indexing, tries to generate a small amount of alpha, which is excess return, while keeping tracking error very low. The choice depends on the investor's belief in market efficiency.
I like that. If I think the market is like a hyper-efficient casino, I go passive. If I think I'm the next superstar picker, I go active. What is the level 3 secret regarding choosing between these?
The secret, James, is matching the management style to the cost and the expected inefficiency of the market segment. If you are investing in a highly efficient market, like large-cap US stocks, active management is statistically unlikely to add value after fees. Conversely, in inefficient or niche markets, active management has a higher probability of success. If the exam asks you to justify an implementation choice, you must link it to the efficiency of the asset class. Always mention that the fee drag of active management can outweigh the potential performance gains in efficient markets.
Fee drag is the silent killer. It's like paying for a fancy sports car but only driving it in the school zone. So how does this link back to the goals-based approach we mentioned earlier?
It is crucial, James. In a goals-based framework, you aren't just looking for the highest return for the whole portfolio. You are implementing specific strategies for specific 90 buckets. One bucket might be for retirement, requiring low-cost passive growth. Another bucket might be for a speculative goal, where you might use active management to try and hit a home run. Each bucket has its own unique implementation mandate, aligned strictly with the goal it serves.
That makes so much sense. Tailoring the tool to the specific job. Doc, give me another quick GPS check before we hit the rebalancing section.
We have traversed the economic balance sheet, asset classes, factor-based risk decomposition, and the strategic allocation process. We then moved into the implementation phase, distinguishing between passive, active, and semi-active styles within a goals-based or traditional context. Now we must address the final piece of the puzzle, rebalancing the portfolio to maintain our target weights. This is the heartbeat of the strategy, ensuring that the risk profile does not drift away from the target.
Rebalancing feels like mowing the lawn. The grass is always growing, and if you don't cut it back, it gets out of control. What's the analytical way to look at this, Doc?
It is a delicate balance, James. Rebalancing acts as a discipline that forces you to sell high and buy low. When an asset class outperforms, its weight in the portfolio increases. By selling the winners and buying the underperformers, you revert to your target risk profile. Analytically, we have to weigh the rebalancing premium, the expected return benefit, against the transaction costs and taxes incurred. If the transaction costs exceed the expected benefit of maintaining the target, then rebalancing is counterproductive.
So it's not just when it hits a percentage, but whether it's worth the tax bill. That sounds like a classic exam trap.
You are absolutely right, James. The exam will test your ability to balance these conflicting objectives. You must consider the tax implications, especially for taxable accounts and the trading costs. A wider rebalancing corridor, the range around the target rate, can reduce costs but increases the risk of drift away from the strategic goal. If you are asked to formulate a policy, you must argue for a corridor that balances risk control with cost management.
That makes sense. If the corridor is too wide, your boat is drifting into the rocks. Too narrow, and you're just paying commissions to the broker. Let's look at the numbers. If I have a 60-40 portfolio and stocks surge to 65%, do I rebalance?
That depends on your defined corridor, James. If your policy allows for a 5% deviation, you are at the limit. However, a deeper analysis considers the liquidity of the underlying assets. If the stocks are highly liquid, rebalancing is cheap. If the stocks are illiquid or the tax cost is high, you might choose to drift a bit further before acting. The decision is never purely mechanical. It is always an optimization problem involving risk, cost, and the specific constraints of the investor.
That makes perfect sense, Doc. It's about finding the Goldilocks zone, where the benefits of rebalancing aren't eaten by the costs. Speaking of costs, let's talk about tax awareness. How does that change the game for a private investor compared to a tax-exempt endowment?
That is a critical distinction, James. For a tax-exempt entity like a pension fund, you rebalance purely based on risk targets and transaction costs. For a taxable individual, you must add tax efficiency to your model. You might choose to rebalance by directing new cash flows into underweighted assets instead of selling winners. This avoids triggering capital gains taxes entirely, which preserves more wealth for the long term.
So instead of selling the winners and paying the tax man, I just feed the losers until they grow back to size. That's genius. It's like pruning a bush by watering the short branches instead of cutting the tall ones.
Precisely, James. We call this rebalancing with cash flows. It is a superior method for taxable accounts because it minimizes realized gains. If the exam asks you to justify this approach, you must emphasize that it defers taxes, which enhances the compounding effect on the portfolio. You are keeping more capital working for the client. The analytical win is understanding that tax drag can be larger than trading commissions.
I love that. Tax deferral is basically an interest-free loan from the government that you get to reinvest. Now, Doc, what about the life cycle of the investor? How does the risk capacity change as they move from their 20s to their 80s?
Risk capacity is fundamentally tied to the human capital we discussed earlier, James. In your 20s, your human capital is vast. You have decades of potential earnings ahead. You can afford more financial risk because your human capital acts as a giant, low-volatility bond. As you retire, your human capital drops to zero. You now rely entirely on your financial capital, so your risk capacity decreases significantly. Your portfolio must evolve to reflect this shift.
It's like transitioning from a high-stakes poker game where you have an infinite stack of chips to one where you have to play very conservatively to protect your last few dollars. How do I calculate this shift on the exam?
You do not need to perform complex calculus, James. You need to demonstrate the logic of substitution. You must explain that as the human capital portion of total economic wealth declines, the financial capital portfolio must compensate by increasing its allocation to high-quality fixed income assets. This maintains the desired risk profile for the total economic wealth. The examiners want to see that you understand the inverse relationship between human capital and appropriate portfolio volatility.
That's a crystal clear mental model. Let's do a quick GPS check before we tackle the institutional nuances. Where are we standing?
We've mapped the economic balance sheet, dissected asset classes, utilized factor models for risk, and established the strategic allocation process. We've covered implementation styles and the discipline of rebalancing, including the critical factor of tax efficiency. We are now pivoting to how these concepts apply specifically to institutional investors like foundations, endowments, and insurance companies. Each has distinct liability structures that define their investment horizons and risk appetites.
Institutional investors don't have to worry about retirement or lifestyle in the same way, but they have their own bosses, right? What is the main institutional trap I need to watch out for?
The main trap is assuming all institutions behave the same, James. A foundation which must pay out a percentage of its assets annually faces a different constraint than an insurance company, which must pay out claims when they occur. For a foundation, the payout requirement is a spending constraint. For an insurance company, it is a liability matching problem. You must analyze the cash flow requirements of each institution before suggesting an asset allocation strategy.
That's a vital distinction, Doc. Insurance companies are playing the ultimate game of match the cash flows, whereas foundations are more about sustain the mission. If I'm at the exam and they ask me how to determine the asset allocation for an insurance company, what's the anchor?
The anchor, James, is the liability relative framework. For an insurance company, you must prioritize matching the duration and the cash flow timing of your assets to your liabilities. This is called immunization. You are trying to make the portfolio value insensitive to interest rate changes. If the exam asks you to justify this, argue that failing to match assets and liabilities creates structural risk that could threaten the company's solvency.
So it's not about beating the market. It's about ensuring the checks don't bounce. What about foundations? Do they have to be as rigid as the insurers?
Foundations have more freedom, James, but they face the spending rate constraint. They usually have a legal requirement to distribute a percentage of their assets annually. Their strategy is often non-goals-based, designed to preserve the real value of the endowment while generating enough income to fund their operations. The trap is to chase high-risk growth that might lead to a shortfall in bad years, forcing them to cut grants when they are needed most.
That makes sense. You can't give out scholarships if your portfolio crashes exactly when the students need the money. Doc, give me a quick GPS check. Where are we in this institutional marathon?
We have successfully covered the economic balance sheet, our foundational tool for viewing total wealth. We explored factor models for granular risk assessment and discussed the nuances of implementation and rebalancing. We have now analyzed how these principles apply to the institutional landscape, contrasting the liability-driven approach of insurers with the spending-driven approach of foundations. We are nearing the end, James. Let's look at how to synthesize all of this into a coherent final investment policy.
Synthesizing it all feels like finishing a complex jigsaw puzzle. If the exam asks me to formulate an investment policy statement for a complex client, what's the structure I should follow?
A well-structured policy statement, James, must start by defining the objectives, the why of the portfolio. Then it explicitly states the constraints, the limits on time, taxes, liquidity, and risk tolerance. You must then link the strategic asset allocation directly to these objectives and constraints. The win on the exam is ensuring that every part of your policy has a direct, defensible link to the client's specific, identified needs.
So the why, objectives, dictates the how, strategy, and the rules, constraints, define the boundaries. It's a closed loop of logic. Any last-minute warnings for the exam?
My final warning, James, never ever ignore the total economic wealth. Always remember that the financial portfolio you are managing is just one piece of the client's larger extended puzzle. Whether you are dealing with a doctor's personal retirement fund or a large university's endowment, keep that broader perspective. It is the hallmark of a truly analytical and successful investor. You are now prepared to think beyond the balance sheet.
Doc, we've walked through the whole process, but what if the client is just emotional? How do I factor in behavioral mistakes when formulating the policy? Or does the curriculum ignore the human side?
The curriculum absolutely addresses behavioral finance, James. It acknowledges that investors often suffer from loss aversion or overconfidence. Loss aversion causes investors to hold losing investments too long, hoping to break even. Overconfidence leads to excessive trading and higher risk-taking than justified by their capacity. On the exam, you must argue that the investment policy statement acts as a behavioral guardrail. It prevents the investor from acting on these psychological impulses during market volatility.
So the policy statement is like a prenup for your money. It keeps you from doing something crazy when your emotions are running high. How do I justify this to the graders?
You justify it by stating that behavioral biases violate the principle of rationality underlying the economic balance sheet. You argue that the formal written investment policy statement forces the investor to remain objective. It mandates that all investment decisions be based on the established objectives and constraints, not on temporary feelings. The trap is to assume the client is always rational. The win is to build a system that protects the client from themselves.
That's a brilliant way to wrap it up. The system protects the human. Doc, we've covered the entire module now, from the economic balance sheet to the psychology of the investor. Any final advice for the exam itself?
Focus on the clarity of your logic, James. The graders aren't looking for encyclopedic knowledge, they are looking for the ability to apply these concepts to the specific scenario provided. Read the case facts carefully, look for the specific constraints, and ensure your recommendations directly address them. If you can clearly explain the why behind every decision, you will pass. You now have the analytical framework to handle anything they throw at you.
And there you have it, everyone. Good luck preparing for your exam.
Success in this field isn't just about the math. It is about the discipline to remain rational when the market demands hysteria. You have the tools, the framework, and the intellectual rigor. Now go apply them with precision. Don't let your brain be the leak in your portfolio. Class dismissed.